Expense Review Committee. It's November 18th, 2021. I'll call for order. Roll call. Harvey Lewis, member.
David Reeder, member.
Pat Keel, member.
Matt Barker, member.
John Tennis, Anco Consulting.
Greg Williams, staff.
William Johnston, staff.
Diane Wilson, staff.
Everybody
And
else?
other people who have joined us virtually announce their name and association.
Matt Buxton, Loomis Sales.
Jonathan Kimbrough, Loomis Sales, Discipline Alpha Team.
Mark Benton, staff.
Okay, also. Okay, everybody, we need to adopt the agenda? Most adopt the agenda.
So moved.
Second. All in favor?
Aye.
Okay. Approval of the minutes from the
Move the approval of minutes.
Second. Motion second. Any corrections or deletions or anything? All those in favor?
Aye.
Okay. First up, Loomis Sales, Matthew Bruxton and Johnson Kimbrough.
Good morning, everyone. This is Matt Buxton and Jonathan Kimbrough is with me as well, joining from the West Coast in California. So quite an early morning for him. We appreciate the time today, and we appreciate your continued confidence and investment with Loomis Sales. We thought today we'd run you briefly through a firm update, take you through a little bit of performance and some attribution on the portfolio, and then spend the balance of the time and the bulk of the time discussing kind of where we are in markets, rates, inflation, et cetera, and then discuss how the team is positioned related to that. Does that work for everyone?
Yep.
Great. Well, briefly, I'll just take you to slide 3 of our presentation. Just a quick update on the firm. If you look on the left-hand side of the firm, I'm not sure if we discussed this at the last meeting, but you'll see a new dot there for Utrecht in the Netherlands. Loomis Sales did lift out a European credit team, both investment grade and high yield, in November of last year. And the reason I mention this is not because European credit is something that's huge appetite for in the United States, but what it does speak to is the strong footing that Loomis remains on with our parent company, Natixis, to be able to add an investment capability of scale and size in the middle of a pandemic. Does speak to the strong backing that Loomis has as a firm, and we're really excited to add this team. But it really does speak to how strong and how stable the footing that Loomis remains on with our parent to be able to do this in the middle of pretty unprecedented times. I think if you look at the right side of the page, you can see the AUM is just under 354 billion as of 9/30. If you go back to our last presentation, it was about 328 billion. So pretty strong asset growth. We're seeing that across both our equity and fixed income platforms. Certainly a little bit more on the fixed income side in the last year. And, our Discipline Alpha team in particular that you're investing in has seen some strong asset growth and some large mandate wins since we last spoke. So continue to see strong client activity. Performance remains strong across our platform. And continue to really have a strong partnership and a strong foundation with our owner, Natixis. The only other slide I would briefly point to you is slide 6. And the reason I bring this up is just really to discuss kind of how we are giving back and investing in our community. As you're well aware, Dan Fuss has been a member of Loomis Sales for 45 years. He's an iconic investor in the fixed income world. And we have started a foundation that works with Dan to raise mental health issue awareness, including suicide. Unfortunately, Dan has been touched very closely by that. And you can see over the next 3 years, we put a big corporate giving strategy together. We're doubling employee matching for donations to this. And we're sponsoring a lot of engagement and volunteering, both with our employees and across all the areas and all the cities that we have offices in. So it is a focus for us. And it's something that, we're very proud of partnering with Dan and his family and certainly trying to raise awareness of this issue. So it's just something that we point out as a sign that, we're committed to working with the communities that we're involved in and trying to do our best to pitch in and help where we can. Before I turn it over to Jonathan, any questions on the firm at all?
Oh, we're good.
All right. I'll turn it over to Jonathan and he'll take it away.
Thanks, Matt, and good morning, everyone. Thanks for the opportunity to give an update on the Discipline Alpha team. As Matt mentioned, we are located in Orinda, California, though we've all been working from our home offices for the past couple of years, as everyone else is. And in normal times, we are fully embedded with the Luma Sales organization in Boston and frequently in contact with Matt and research and portfolio managers there. The team is headed by Lynn Royer and Seth Timon, and Seth was promoted to co-head at the beginning of this year, and I think that's gone very well. Seth is beginning to pick up some of those leadership qualities that were a little rough at the first couple of months, and he's really kind of getting into a nice stride serving as co-head. The team is fully staffed at 18 people now, and we have no more plans for new members at this point. In fact, we added 4 new junior members in 2020, and they've all been doing nicely onboarded. In fact, this afternoon, for the first time in 2 years, we're going to have an outdoor picnic where everyone in the Orinda office will come together. So it'll be the first time where everyone's seeing some of those more junior members in person. I'll make a couple comments about the Discipline Alpha platform, which you could follow along on page 8. The team is currently managing $19.4 billion in assets, and of that, the core Discipline Alpha strategy in which the city of Gainesville is invested is over $10 billion in assets at this point. We reached the 10 billion milestone recently and also have a 10-year track record in the core strategy, which we're very proud of. Performance has for the strategies have done well over the past couple of years, and our fundraising and asset growth has continued as well. We've seen a lot of interest in the core strategy, and in particular, a long corporate strategy is a lot of corporate DB plans in the United States have moved further along their glide path and moved more assets into long duration fixed income. We've seen about $3 billion of net inflows this year to date, roughly split between core and the long corporate strategies. A brief reminder of the Discipline Alpha process. You can see some of our key points of our investment philosophy on page 9. Is that this is a core strategy that's benchmark aware. The 2 key principles of our process is we believe that we can earn alpha by relative value investing, by consistently coming in and looking at what are the best opportunities in the portfolio on any given day. Has something changed in the industry or issuers and fundamentals that has happened overnight, or we can look at new issues. And really every day we're coming in and taking a fresh look at the portfolio to see where we might be able to earn another basis point or 2 in small, consistent contributions. The second principle is that risk management is really fundamental to the process, and we manage risk very tightly in this strategy. The primary risk factor in fixed income is interest rate risk, and we manage duration very close to the benchmark, keeping duration neutral, and even managing that within a 0.03 year band to make sure there's not any unintended interest rate risk in this portfolio. We also keep issue or industry concentrations very close to the benchmark. So overall, you have a portfolio that resembles the benchmark. It acts like the ag in times of down market stress when you need it to. But due to our idiosyncratic positioning, you have a consistent source of alpha generation from bottom-up positions over time. One page that illustrates this really well is page 20. And this is the quarterly excess return track record for the entire strategy. And you can see that since the inception in 2010, there's been only 3 quarters of down performance, and really the magnitude of those have been quite small in relation to the consistent outperformance just on a quarter-end basis of a few basis points here and there. On the following page, this chart breaks down the attribution of our core strategy since inception. And what I want to point out is the top blue line is the total cumulative return of the core strategy, earning 88 basis points gross of fees annualized. The orange line right below that is the attribution coming from security selection, which again is the primary source of alpha here, and that is represented 76 basis points of the total 88. Allocation does provide some benefit at 12 basis points, and this is primarily due to our overweighting of credit or ABS or other sectors relative to the benchmark. And lastly, you'll note that the contribution from rates is zero, meaning that our effective rates and interest rate management has mitigated interest rate risk in this portfolio, allowing for that sector and selection to be tools. Now, this is for the entire composite track record. We could turn more closely to the performance of your account, which is on page 25. Since Gainesville's investment in the Cordis-SPAN Alpha NHIT in December of 2016, the trust has earned 39 basis points gross of fees on an annualized basis. And over the 1 year period, 42 basis points of excess return. On the following page, we have attribution for the quarter to date and year to date period. And I might just mention briefly a quick name here due to the interest of time. But what I would note at the top is that in the third quarter, the portfolio outperformed by 14 basis points, and really all of that was coming from security selection. The contributors and detractors you see below are quite diversified. So for example, Southern California Edison's contribution in the quarter was about 1.5 to 2 basis points. And the top detractor for the quarter was about -2 basis points. So the sources of attribution are highly diversified, many different positions in the portfolio providing small contributions rather than an outsized return from any name. On the year-to-date attribution, you can see selection was again the primary driver of excess return at 27 basis points, though we did have some benefit from sector allocation, primarily overweighting credit and our ABS. And our curve positioning was also beneficial during this period as we had a modest overweight to the 30-year key rate duration relative to the 20-year key rate duration, and 30-year bonds performed very well due to the rate movements in the quarter. One individual contributor I'll just mention is Southern California Edison. This is an electric utility, and it's a name that we find a lot of good relative value in relative to other electric names. Southern California Edison is a utility in Southern California that has a much smaller territory and service area than something like Pacific Gas and Electric. They've also done a better job of property management, vegetation management for wildfire risk, as well as modernization of their lines, such as putting power grounds underground. And we just think they've done a better job overall in managing wildfire risk. Now, during the summer, when wildfire risk and drought concerns were an issue in California, you saw a lot of these electric utilities sell off on that wildfire risk. And Southern California Edison was a detractor for that during that period. After the course of the summer, though, once wildfire risk has somewhat receded, we've now had rains in California, and due to the fundamentals of their better wildfire management, Southern California has been a contributor in this period, and we continue to like that name going forward. I think at this point, I'll just turn and speak maybe to our outlook on the credit side. After credit spreads tightening much of this year, we've seen credit spreads beginning to widen in the third quarter and late recently. We have a moderately constructive view of credit markets because of this. Valuations are obviously very tight. Credit spreads are near historic lows, even though they have widened a little bit. And this has led us to have a moderate overweighting credit of just a 5 pi positioning, which is a very, very modest overweight that's reflective of the potential downside from valuations being so tight, but also positive technicals. There continues to be a lot of foreign money that's being put to work, particularly on the front end of the curve. And so we continue to see pockets of interesting opportunities in credit that allow us to have this modest 5 pi overweight. Let me pause there and see with the remaining time what would be best to cover. I could go into a little bit of industry positioning, or if there's any questions from the committee, maybe we could take those and see how you'd like to spend the final minutes.
Jonathan, this is John Tennis with ANCO. Can you talk just about inflation and what you're seeing there?
Sure. I was looking at one of the measures of inflation that the Fed looks at for Michigan, and It was coming in at 2.9% yesterday, which if you think about the long-term inflation targeting of 2.5, 2.9 doesn't sound terribly higher, but I think that masks a lot of pockets of inflation in various parts of the economy. I think one area that we've seen in particular is chip shortages that have led to automobile shortages and new vehicles prices being higher. In addition, you've seen precious metals, certain metals that are inputs into iPhones or other technologies also have considerable price increases. I think on our team, when we think about whether this inflation is transitory or sticky, we're becoming to realize that it's more sticky. And particularly some things like, while we have seen an abatement in home prices recently, we think wage inflation is currently a factor that's been underrepresented. And it's something we're certainly seeing in the industry as well, and people being able to move jobs quickly and go to other firms. So I think what that means for the portfolio is, for us being an investment grade bond portfolio, we feel like a lot of the issuers we own have the capability to pass through that inflation to consumers. So there's, from our perspective, nothing immediate effect in the portfolio, but these other inflation macro factors kind of guide our positioning in the bottom-up selection.
John, I have a question. You mentioned the portfolio and the effect of interest rates on your portfolio. I guess what camp do you guys sit on? I know there's two trains of thoughts. Lower rates for longer, and or rates going up significantly in the next year and a half or so. What are you guys feeling, or what are you thinking, and how's that going to affect you?
I think for the biggest thing, I think there's going to be more volatility in rates over the coming year. And we do expect rates to move moderately higher, maybe, but nothing considerably higher over the course of the year. For our portfolio, I think because we are running duration neutral, there's no immediate portfolio management implication, but certainly it's caused us to look more at curve positioning. We tend to have a structural overweight to the 30-year part of the curve relative to the 20-year, and that's primarily because a lot of bonds are issued in 30 years, and 20 years tend to be old 30s. So that's been an area where we're constantly looking at the flattening and steepening of that part of the curve. Beyond that, it has, we're not doing any duration or interest rate positioning beyond modest curve trades.
Okay. And just last question, are you fully invested at this point, or is there some cash in your portfolio?
No, we remain fully invested at all times. Generally, cash is less than 1% of the portfolio.
But hasn't risk gone up a lot? I mean, if inflation is sticky and you get to historical relationships to inflation, as I learned it in economics, it's 200 basis points off the inflationary expectation for a long rate. Wouldn't rates be going up an awful lot and values down considerably?
Sorry, what was that? Wouldn't rates be going? What was the question?
Wouldn't rates be going up if inflation is in fact sticky? I mean, if nothing else, wouldn't the risk of increased rates be going up substantially right now?
Yes, it would. I think particularly that should be a draw on the long end. Often you see technicals or strength in the long end and buyer bases coming in and changing the inflation rates. But yes, if inflation is sticky, you would generally see long end rates increasing over time.
One other thing, John, you use the term the excess return, and that's the way you seem to measure things. What does that mean? What's the definition?
Excess return?
Yeah.
For our strategy, so if the Barclays Ag has returned 50 basis points and our strategy's returned 52, 2 basis points is the excess return.
Okay, against a benchmark.
Yes, correct.
Jonathan, this is Harvey. I have a question. How's the Fed going to figure in this? When they
How's
start to ease, how's the Fed going to figure in if they start to ease?
Well, I think the Fed has indicated that asset tapering will begin, and that the path of that has been a little faster than expected. Some market participants thought that they would taper over the course of the year, and it now seems like the tapering will be done by the middle of next year. I think you've seen in the month of October, you've seen short rates rise quite a bit based on that. I think that was largely market's anticipation of short rates going higher in the near term, perhaps ahead of the Fed schedule. And meanwhile, you've seen a lot of other central banks around the globe, like the Bank of China and the UK, also have some hawkish actions as well. So I do think, the Fed is trying to telegraph a plan, but the market is perhaps saying that rates will advance a little quicker than what the Fed's laid out at this point.
It's Pat again. But if the Fed tapers and inflationary expectations persist higher, how does the federal debt play into sort of the credit markets? I mean, then you have, it would seem to me, the debt service on $29 trillion worth of federal debt going way up. I mean, how does that affect the bond markets generally?
This might be out of my area of expertise. I think, you're getting into more economic debate. It's maybe something we could come back to you on and pull macro research for.
Okay.
But I would agree those forces would be inflationary. Matt, anything you want to add?
Yeah, I completely agree. It would be inflationary. I think when you think about this team and how they manage the portfolio, they're really trying to mitigate that risk as much as possible every day. And so that for them, you may see it, and Jonathan, correct me if I'm wrong, you may see it in sort of price movement in some of the bonds in the corporate market, but you're not going to see the portfolio being negatively impacted by whatever happens in the treasury rate market, because we mitigate that interest rate risk down to such a low level. So this portfolio really does isolate those idiosyncratic credit risks that the team wants to express. So for your portfolio, it shouldn't be a major impact, positive or negative, to the performance. More macro, we can certainly reach out to our macro team, and I can have some research, and we'll send some research over to you that they're doing on it, because it is something they're very aware of. And we do have portfolios at the firm that do invest in a more macro manner, and becomes a bigger issue for them.
Can I ask a question about how you manage the portfolio? This is William Johnston. I see that your alpha year to date, you're attributing company selection to a lot of that performance. And I'm just curious, on a trading basis, is that just simply you're buying credit and it's improving in quality or outlook and going up in price, and then you're turning that over and you're selling it for more than you bought it for?
Yeah, so it's a little more complicated than that. Oren Shayet is our quantitative strategist, and he's designed our attribution model to really pull apart the sector allocation effect versus the issuer effect from really each bond level. So, let's say we owned the benchmark weight in a bond, you wouldn't see any attribution from that if we had the same, positioning as the benchmark. So what Oren's attribution will do is it'll pull out any sector effect, and then really leave the issuer effect, which can also be and there can be certain, for example, AT&T has 53 different bonds in the benchmark. So individual tenors and individual bonds along that can certainly make a big difference in performance, and that would flow into this selection bucket here. This is also the selection from mortgages and ABS as well, in addition to credit.
Thank you.
Else? This is Harvey, the macro report, would you send that to William for distribution?
Yes, I can send it to William. Yeah, I can. I'll put I'll pull some data together from our team. It'll be sort of a much more product agnostic macro outlook on Fed action, interest rates, inflation, and the team's view on that. And I'll share that with William. And we're happy to, if you'd like to talk to our macro strategist, we're happy to set up a call with that. It'll be much more just market driven, and just talk about where we are kind of in the credit cycle. And what that team's view is on the macro environment. I'm happy to do that as well. But let me start with that document, and then we can go from there.
No more questions here.
Okay. Well, we thank you again for the time, and we thank you again for the partnership with Loomis on this portfolio. I will pull that information together and get that over to William. And if we don't speak before, I hope you guys have a great Thanksgiving and a great Christmas, New Year. And please don't hesitate to reach out to me at any time with any questions you may have related to this portfolio, or obviously macro environment more broadly. You know, Loomis is a very deep and well-resourced asset management firm, and we have a tremendous amount of teams that have completely different views on any number of investment topics. So we're happy to share that with you if it's helpful.
Thank you.
Thanks.
Thanks. Thank you. Have a good morning.
Thank you. Bye-bye.
John Tennis from ANCO is standing for Brandon, and
Hold on a minute, just, so they've got 30 million of our dollars invested. I'm reading from your report you're about to get into. And so somebody that was around in January of 17 when I was not, could maybe tell me, we do fixed income with them just because we want to have a small part of our portfolio of fixed income. I mean, it's just a conservative touch. You just do this.
that probably, I'm gonna bring that up today, is that old school thing?
Oh, okay, I'm sorry.
No, that's-
If you want to talk about this. I
Well,
didn't-
actually, Loomis is really interesting. It was a change from, I can't remember who was before Loomis, but they did
We
that.
had, I believe they replaced Richmond Capital, which we had for a very long time, but the way they ran their portfolio, it was set up to be more defensive, but it didn't turn out to be as defensive, I think, as we wanted. And so you weren't really gaining alpha in up markets, and we weren't getting quite the protection we hoped for in down markets. So back in 17, I guess, is when we made the change from Richmond Capital to Loomis.
And it took like 9 months because all of this.
And to your question, I mean, from a sort of a cash management standpoint, I think at least staff looks at fixed income as a place that you can source funds from if you need it in down markets and equity down markets. So not that you have to do it, but say we would draw cash from the investment account pretty much once a year toward the end of the fiscal year. And that's to cover the differential between the pension contributions and the benefit payments, because we have a monthly negative cash flow. We allow that balance to go negative during the year, and then we true it up at the end of the fiscal year because we don't want to show a negative balance on our financials. We can make withdrawals from the account, the investment accounts, anytime we want. We tend to wait until the fourth quarter of the fiscal year, which is July to September. If we happen to be in a crisis market where we're down 20% on all of our equity managers, then we would probably source the funds, from the fixed income manager. Okay. So, and over 25 years, we've never been in a situation where we were down 20% with all of our managers, in that time frame, but it could happen. But
Okay, John.
Okay, so my apologies for Brendan not being here. So I have good return, so hopefully it's not too much of a problem. But Brendan said you guys did like this page here, just real quick. March of 2020, when the market went down, 35% in 23 days. You can see the journey we've been on since then, which is pretty crazy during a pandemic. The market is up, you can see it over 110% over that time period. And I believe, I'm kind of colorblind, but it's the dark green area here. Yeah, that's pretty crazy that the last year and a half of a pandemic that the market is up 110%. So yeah, it's a good chart, but yeah, a good visual. And then if we turn to the big book, since Jonathan and Matt with Loomis talked about the markets, I'm going to do a lot less lifting here than I normally would. But on page 5, yeah, just I jokingly say that if you want to fall asleep at night, you can read these pages. But yeah, there's a lot of good information here. But since Jonathan and Matt at Loomis talked about pretty much everything I was going to talk about, I don't need to repeat that. But I think with the inflation is a concern, and with this global supply chain issues that we are having right now, and more people. I always say Americans, we're all stupid and spend all of our money. Not all of us, but in general. So there's a lot of demand out there and not so much supply. And then the energy stuff. I know when I had to go back to Orlando, it's going to cost me probably $60 to fill up my car. So all that stuff is contributing to the inflation numbers that we are seeing. And as Jonathan and Matt mentioned, we like last quarter, I'm sure Brendan even said the word transitory. But then when Jonathan was talking, I actually wrote down here, it's going to be more sticky than we thought. So I think we have, in my mind, probably a couple more quarters that we're going to be talking about inflation for a while. But it is going to be, higher than what we thought, even from a quarter ago. So that's the big issue for this book. And then also probably the next time you see Brendan, I'm sure he'll be talking about inflation again.
Back to Loomis. They're 20 and 30 year. Any bond rise in the future, in the short future, it's going to be short term. Is that correct?
Any bond rise or interest rate rise?
Interest rate rise is going to affect the short term bonds first.
Yes, and he mentioned like the Fed, right? Because the Fed's goal ultimately is 2.5% over the long term. In the last decade, it was 1.5%. So basically, they said they were taking a look at the next decade, so they're going to let it stay higher. But that is they're smarter than I am, but that is something that but
they're in the bond business.
Yeah, they're.
Yeah, but I don't think the Fed will raise. I think it'll be slower than what people are anticipating. And then the Fed controls the short end of the curve, and the market has already kind of, as they mentioned, has kind of priced in the inflation part. So rates have gone up. So they might go up, a little bit in the short term, but a lot of that is already baked in on the long end of the curve. The 30-year bonds that they were discussing.
We have a fuel hedging program that we implemented a year or so ago, and it's done pretty well. And if you buy futures and fuel prices go up, you do well. So we had about $1.5 million in cash sitting in the account, and it was just sitting there. So we decided to buy a treasury note. And we talked about it at our committee meeting back in August, and I thought we'd wait a little while and see what rates did. And so instead of buying a 3-year note at 40 basis points, we locked in on Monday at 85 basis points. So more than double what we could have gotten.
Not too, I mean, good for you, but not
for us.
good.
We've been expecting interest rates, it seems, to go up for 30 years.
Wow,
Yeah, and it, if you bet that way, it really hasn't been too bad. What's different, it seems, it's always a challenge to talk about things that are different. What seems to be really different is the employment costs. I mean, I can't tell you how many help wanted something sort of, and that seems to be sticky for whatever reason. And that is
They've got money in their pockets. They don't want to work right now. Wait till that runs out. It will run out. I don't know when. It will.
You keep hearing that, but it just
They
doesn't.
got a lot of it though. They got a lot of.
Yeah, but it's $1,400 a clip. I mean, how much is that? How long is that left? So it may very well be that it is going to be very sticky and persistent, and you're finally going to have interest. I mean, how much they can't go lower. If that's the case, now don't you question being in bonds and all that? I mean,
Yeah, I mean, I will say your portfolio is only as a 4.2% in bonds right now. And that's extremely low compared to every other plan. Let's just say the state of Florida, which I have like 50 plans. That's extremely low. And I think Lunas is a great manager. They've done a great job for you guys over the long term. So I know the concerns in the fixed income, with, inflation and interest rates and all that, but at the same time, you guys only have, about 4% of your portfolio, which the norm used to be 40%, right? Back in the 80s.
No. But even still, I mean, if I had 4% of my own funds in bonds, I'd be moving probably into dividend growth stocks. Persistently dividend growth stocks. The dividend aristocrats are champions.
Yeah, I understand. Yes.
I mean, it's just, I can match the bond rates and I get growth.
Theoretically, right? The market keeps going up. Yeah, theoretically. Yeah, no, I do agree with you, but being at 4% though, I mean, you guys are definitely on the, I think there's a chart in here. Yeah, I can get to it on page 22, but you can see how you compare to all the other thousands of pension plans on the fixed income side.
Whoever brought it down to 4% was doing the right thing.
No, you'll see that in the returns here, I guess.
Well, we've argued that
Brandon.
position for a long time, that, we look, some people have heard me say this, we look at the pension plan as perpetual, or, we look at it as a 100-year plan. And over 100 years, we've tried other asset classes to replace fixed income, like hedge funds, and we've looked at private equity, and we've looked at real estate. And we have some real estate, but there are factors associated with all those types of classes, from liquidity to transparency to fees. And we had really bad experiences with a couple of hedge fund funds in the 2000s. And to me, if you look back after 100 years, what asset class is going to give you not only probably the best returns, but also daily liquidity, transparency, and low fees, and that's equities. And nothing against consultants, but consultants and a lot of people don't like to see volatility in returns in their pension plans. They don't like to see down markets. That's the reason we like that chart that was shown previously, where you see the drawdowns in the market, but then the recoveries. Because the pension plan is so long-term, we're not concerned about short-term volatility, because we believe over the course of time, you're going to get paid for it if you're in equities, which is why we have such a low allocation to fixed income. At this point with 4%, I've argued for 100% equity in the past. And over the long term, I think that's still the best asset allocation. But to have 4% in fixed income is sort of like having it in cash, but paying a little bit to have it in cash. So even if you're down, you're not going to be down too much. And it provides some liquidity if we need it. And if you did happen to see, the equity markets have a correction of 10%, maybe you could put some of that money back into equities.
Because if you were thinking about dividend growth, not just that dividend growth, that steep drop in March, effectively, the income actually continued to go up a little bit.
Right.
Okay. So even though you've had that kind of dip in that component of return, in terms of values, the income generated.
In our value equity managers, they're looking at dividend yield equities. So we have, some of our portfolio is focused on that.
Yeah, and I think too, with $30 million of your 720, it's actually going to be more today. But having that as and using it as kind of cash when you need it, because even when they do, if fixed income is negative, it's not that much.
So that's your priority in cash withdrawals, is out of the fixed income.
Well,
That's his history.
it depends on where we are in the markets when we look at it. If we have managers who have outperformed and are above their asset allocation targets, we'll probably rebalance from those managers. So we'll take it from the, we use it as a rebalancing tool as well. But it really just depends on where we are in the markets in the last quarter of a given fiscal year. And, if all of our managers or all of our equity managers are down, then we'd probably try to source some, if not most of the cash from our fixed income manager.
And what is that cash flow been normally?
I'm sorry.
Like,
Oh, so
I know it fluctuates. I'm
it's
not
been
asking
it's
that.
been about 2% of the portfolio. So we've changed the way we make our contributions to the pension plan the last couple of years. We used to do it for employees, it's still done on a per payroll basis, but the city used to do it on a per payroll basis. And now the general government side, not GRU, but general government puts it all in a lump sum in October. So they're putting the full year's worth in. So that increases a little bit more of a positive cash balance at the beginning of the fiscal year. But, just to give you a ballpark, we took out 24 million in September. And that was to bring us positive in our cash balance internal to the pension plan for fiscal year 21. So it's in that ballpark. I mean, now with, after the pension obligation bond proceeds were deposited and the performance we've had, now it's, down closer to, 1% or less of the cash withdrawal every year.
I was going to ask, even as little as we have in bonds, I didn't know about that's if it's all done through rebalancing. At this point in time, we need to be there. That's just the honest
The
question
argument
have.
could be made that you don't need to be there, especially if you expect them to have negative returns over the next couple of years. But, as John said, we don't think the negative returns are going to be, it's not like an equity market where you're going to be down 20%, hopefully. I mean, theoretically that could happen, but I guess we like to have it as just sort of a safety measure to have some cash. And again, dry powder in case, you do see a correction in the equity markets and you had some managers that you wanted to top off. It's nice to have 30 million in not in cash, but, a cash substitute that you could withdraw quickly and give to a manager.
Well, I think if they can truly continue to mitigate their interest rate risk, then I think you've got, a decent manager doing a good job.
I didn't get his argument there.
I don't know how they, I don't know how they do it, and obviously that's.
Because he was basically saying that can all happen in the market, but we can isolate Europe.
Correct.
Yeah, so I think
really small margins. I mean, really small, 2 or 3 basis points.
Sorry to interrupt. Yeah, I think what he meant by the mitigating interest rate risk is against the benchmark. So all bonds are going to have interest rate risk.
Yeah,
But I think he mentioned it was for the compared to the egg.
Yeah.
So they're not making big bets on either side. They're just closer to the benchmark and gaining alpha as I saw. Yeah, right there through the selection.
As long as the international rates continue to be where they're at and negative in some countries. I mean, we're in a lower rate for longer. Can't happen. I don't know. Why would you go so many higher? You don't have to.
Because inflation is going to go over.
I mean, it is in certain circumstances, but we also have wage inflation to pay for that. And the best way I think out of inflation is equity.
And equities actually do, in inflationary environments, they actually do decent.
I did find it interesting that one of their top performers was a company called Southern Cal Edison.
I know.
Mark Benton, I don't know if you recall.
I remember it was painful. Yeah.
We owned, my predecessor had bought some Southern Cal Edison bonds back in the 90s, and they didn't perform very well. But we sorted it out,
But they learned their lessons.
I suppose.
William may have learned his. I'm not sure Lewis learned theirs. But it's interesting. It's on both. When you look at that chart, it's on both their good performers and their bad
I saw that.
performers. It's like, oh.
So, okay, I'll just jump to page 18 of my report. So So it actually stinks, on 9/30 was a Thursday. I think it was the worst day in the market on the equity side. And, for your fiscal year, when you close the books, it's 9/30, and then on Friday, October 1st, it went right back up. It's like you can't just do it one day later.
Yeah.
But nonetheless, that's why you can see there on page 18 at the very top line for the quarter, you guys were down negative 1.37. That is lower in the peer group, but I can tell you that these peer groups are getting continually updated, so that number should get higher. But if you go over to the FYTD, the fiscal year to date, you can see there up over 25%. So that's a huge year. And I'll be honest, that I've had probably 25 meetings already this quarter, and that is the highest number I have seen. So that is a very, very strong number, being up 25.73. And then when I look at your 5-year, your 7-year, 10-year, as you mentioned, that this perpetual long-term, those numbers are, tremendous, ranking against, the thousands of plans around the country, not just Florida as well. So I know we do have more equities than the average plan, which has done well for us, obviously, the last 10 years, but I do agree with that thinking. And over the long term, I think it is a sound strategy. So great fiscal year, and then 5, 7, 10, and since your inception, our firm was on around in 1994, but still number one. So you guys are doing it right. So very good from the very top level there.
We're doing it right, except taking our snapshot at the end of the quarter.
Yes, if we can do it October 1st, it would be great.
Tell me about it.
I have my, sorry, I'm gonna go on a tangent here. I have my own theory there is that defined contribution. So, 401a, basically a 401k plan. They have crossed over defined benefit plans in terms of assets, and 95% of new 401k assets go into target date funds, which are essentially, when you look at underneath those target date funds for the vintage years, they're all index funds. And in their prospectus, they have to, most of them rebalance once a quarter. And it seems to happen the last day of every quarter. And people that are, obviously much smarter than me in those hedge funds, like they know it's coming, and they make it go down even more. But yeah, so I really do think there's like a natural selling in these 401k plans that happen, and then people take advantage of that, and then it happens every time. It bounces right back the next day. So I do think that's that's my conspiracy theory.
So buy on the fourth quarter or on the last day of the quarter.
Yeah, sell.
every quarter.
Everybody sell on the last day, and then we'll buy it right back from the next day. I think that has something to do with it, but it stinks that it happened on 9/30 for our fiscal year. But you still had almost a 26% return. And then you can see here in the other handout, we don't have to go through this one, but for the month of October, almost up 4%. And then the market is up today. So yeah, you guys are probably pushing around 5% for the current fiscal year. So I won't spend too much more time on the report, but on page 19, just
While you're on that, though, what are you comparing it to other funds? What about the international equity exposure?
Be higher there than other agencies.
yeah, there should be a page in the back of the book here. Like, what do we compare them to?
Or is your question, is our mix
Is
right?
Yeah.
Is our allocation.
As you did on the bonds, you compared it to other funds. That seems like an awful lot of international equity.
Oh, how you compare? Oh, yeah, you guys definitely have. I would say the average plan in the state has 15% in international. You guys are at 30.
A lot of that is performance driven. They haven't performed that well recently, but our two international managers over the past 10 years, they really outperformed their indexes quite a bit. And so it was just sort of internal growth of those assets because we haven't moved assets away from them.
Well, what do you think, the difference is? Because, you can invest, is that because of foreign sales in those markets, that those equities are anticipated to capture higher sales in international markets? Because you can get the foreign exposure in American equities.
Sure.
There's a significant number, right?
Yes.
Yeah, it's like 50% of the revenue.
Comes from.
Maybe it's not 50, let's just say it's for even numbers, it's around, high 40s that US companies, like the revenue comes from international.
Yeah.
Mhm.
I mean, and so if it's sales, then you can capture that, it would seem to me, by investing in US equities. But if it's something like innovation,
We can capture some of it. I don't know that you can capture all of it.
yeah.
in
But
US.
what you're getting is, you're also getting, it would seem to me, maybe it's, again, is it different this time? That there is more international risk now than there has been recently. The whole China is it seems to me to be posing. a
And that's what happened with
significant risk.
Bailey Gifford. They really got hurt by their exposure in China.
Yeah.
Um,
And is it going to get better?
I hope. There's
For their sake, yes, because that would be one thing I was going to bring up here, but
They could take a public company private in a day.
What's that?
Or they can just,
Chinese.
or they can just kill it. We
Yeah,
we
they
had
Yeah,
an
yeah.
international manager yesterday for a police and fire plant, more out of Toronto. And there was a company there that the government just basically made illegal. It was an educational company. And
Yeah.
so the company just, I guess it's still trading, but it's not worth anything. They privatized all of the learning and teaching that this company was providing. And
And then you think about, Alibaba and what happened to, or is happening to.
Tencent,
Ma and those
sure.
guys, and Tencent, yeah. And then you wonder, what happens in those kinds of situations if Taiwan gets involved, which is.
Well, I mean,
it just
hopefully-
seems like the risk profile has gone up significantly.
yeah, and we've asked our international managers, how they're reacting to that. Most of them are in a holding pattern, like they're not putting more money into China, but they're not necessarily selling either. I think that their take is that, hopefully the market will normalize a little bit and that they'll be able to, decide what companies are worth staying with and which ones to get rid of. But yeah, it's definitely a higher level of risk there.
Or maybe invest internationally in more domestic equities that have significant global exposure. I mean, it's
Right.
another way of capturing that back.
Or, China is considered an emerging market, and so exposure to developed international markets is a different sort of thing as well, right? And I mean, you go through cycles. There was a time in the 2000s where I think there were 4 or 5 years in a row where emerging markets outperformed every other asset class, by a lot. And if you'd had exposure there, you were earning 30, 40, 50% a year in that asset class. And that's not the case now, but typically you hope that when you take more risk, you're going to be rewarded for it. That's the whole point. It just didn't work out. I mean, if China hadn't done what they did with the regulations, emerging or international equities in general haven't kept up with domestic. But, if you look at a fiscal year to date number for international equity of, what is that, 12%, or I'm sorry, 29, 30% for a fiscal year to date, it's hard to argue that's not a decent return. I would like to earn that every year in the entire portfolio.
Yeah, so I think just with your international portfolio, Valley, Gifford, I just sort of note here that, returns long-term are great on page 19, but when you're down 8%, more than that in the quarter.
Yeah.
It's something that we need to keep an eye on.
Yeah,
So
they had a
I'll have
large,
Brendan,
they had a large China. We actually had them discuss it at our last meeting. They had
Yeah,
a
yeah.
large China exposure, and that's the issue.
Yeah. So, but yeah, Brendan and our research team will keep an eye on that. And then if there is further discussion needed, he'll bring it up at the next meeting. So, other than that, I guess I wanted to touch on real estate on page 20. Is that I think we're getting out. I know everybody was concerned about the commercial office space and all that, but to be realistic, I'm just taking Anco as an example. That before the pandemic, consultants are different because we travel a lot, but, the internal people could work from home 2 to 3 days already. It was just that for a year and a half, everybody was working from home, every day. So companies are always already doing that home life, the work life, balance. I still like real estate in your portfolio as a long-term play. And, I know just at Anco too, just starting to see more people start to, trickle in. And just hopefully we don't have another Delta variants and all that, but
Well, a couple of meetings ago, when we had the woman from, where was she from, Kansas City or someplace that chatted with us representing that
Principal?
Yeah, principal. I mean, I just sat here, listened to what she said, just could not believe anything she was saying. Didn't make any sense at all. And yet their numbers are still there, so.
I'd say the most important, the most impressive presentation at the PPT were timberland and agricultural land use. And in an inflationary environment.
Yeah, but that's a little different from what we're talking about.
I know.
Yeah.
Well, you just listen to the fellow with the bond fund, is they haven't been to the office in 2 years. Who says, I can't figure that out. I drive through these industrial complexes and, the parking lot's 20% full. How they stand up, okay. But anyway, the agricultural land, particularly and it's just kind of now being securitized.
mhm.
I mean, it really wasn't that investable.
I will say, is this being recorded?
Yes.
Okay. All right. I have a similar plan. All right, I'll just say it's Hollywood Fire. And they invested in timber.
Yeah.
It has not been a good
Has not been
experience.
good.
I mean, theoretically, you think like if people don't want wood, the trees grow bigger, and then when they need it, you can, cut it down. But the IRR on that one or the last, 12 years is 1%. So yeah, I agree. It sounds interesting and all that, but I think it's still in an infant stage of getting into
It kind of
a.
is, yeah.
Yeah.
And it's appealing being in northern Florida.
They put stuff in
But the agriculture, when you see what's going on with grocery
Yeah.
prices, food prices, and if that's persistent, it's really kind of an early stage.
I'm gonna give Brennan a lot of homework, so he's gonna talk to you about all this
Look
stuff.
at LAND.
LAND. Yeah, he's got a whole list of homework here for the next meeting. But yeah, so overall up over 25%, and then up probably 5% as of we speak right now. So you guys have a good portfolio, and then we'll keep an eye on Valley Gifford and all that. And then I have a large cap growth search for Brown that apparently you guys have discussed in the past. And so I'm not going to go over it, but I updated it through September 30. And then Brennan said that if need be, we can go through that again at the next meeting.
It's really great. On Twin, what if we actually paid it? They finally got us into.
Right, I can go back and check. State Street keeps track of what they pay the investment managers for, so I can get a hard number for you.
It's really, I was just curious because
Yeah.
finally, we didn't pay him until he's finally up some.
Yeah.
And then,
That's just a strange business model. I mean, I get it, appreciate it. But the number of quarters, it seems like he's not performing. He can only work for free for so long.
Yeah. Yeah, I don't know how they were keeping the lights on. I guess,
Well, he has
they
one-
had historically overperformed, which is one of the reasons we hired them. So, they had been making money for a number of years and, maybe they went through a couple of year dry spell, but
Well, I looked at
That's what they say.
the return, I looked at the Russell Index Fund with a couple of big indexers. And you pay them 7 basis points. That's why I was curious as to,
well, back to both Twin and Brown, remember the whole discussion and the whole reason we did the large cap growth manager, sort of not really a search, but an analysis to compare Brown to some other large cap managers. but neither Twin nor Brown are going to own the more volatile stocks in the index that are driving a lot of the index performance, the FANG stocks or whatever acronym of the day you want to use. So, the question to ask is, do you want to own those stocks? And if you do, then you can buy the index, or you could buy an active manager. There are plenty of active managers that will own those stocks. But some point, we decided to be a little more defensive with our equity managers because we do have such a high equity allocation. So that was sort of the trade-off we decided to make. We'll have a 90% equity allocation, but maybe we'll be a little more defensive in our selection of investment managers. And that was, part of the reason that we selected Twin and Brown. I'm agnostic as to whether that's a better long-term strategy than just, trying to find the highest alpha generating managers you can.
Makes sense to me for a pension.
Right.
You can't.
We like to have
For over 10
some risk
years,
management
17.5%. You can't be 7.5% over a 10-year run, so.
Yeah.
And same with Twin. Since it's subsidy, they're a little behind, but still you're
right.
well above.
And they're behind, but without owning those highly volatile stocks, which, I think the fear is that you will eventually see a correction because the valuations, the revenues and the company earnings just don't support the valuations where they are in a lot of those stocks. And so there's this sort of underlying belief that eventually fundamentals will matter again, and you may see those stocks corrected. The large cap growth manager analysis also, that was being driven in part by the former city manager. We have internal committee meetings about the pension plans as well, and he wasn't happy with Brown's performance, and so Brendan attends those meetings also, and the manager was requesting this type of analysis to be continued. So we'll keep looking at it. I mean, Brown's performance, if you see they've underperformed for the entire time we've had them.
It's not significant.
Not significant, and a lot of it, you don't see it here, but a lot of it comes down to like 1 year's underperformance that drags down the rest of the time periods. So there are other managers that outperform them, and that's why we continue to update the large cap growth manager analysis. And if at some point the committee wants to recommend some sort of action, they can do that.
Okay, so I'll pass these out afterwards. But yeah, there's no, for this purpose of this meeting, there's no action that we have, but I will pass it out. And I think that's all I have, unless there's any
Unless you
other.
have anything in your crystal ball, you want life is with.
If I did, I would not be working in Echo.
Tired of
Yeah, I'd be on an island. I fly you guys down and then send you back, and I don't want to be there. I think it's going to be okay. We just got to figure out this energy situation and inflation, and there's going to have to be inventory buildup that's coming once we get the supply chain back. Because they're depleted. Like I just bought my, I have a Ford Explorer that was stolen. I got it back. And my minivan was stolen, my wife's minivan. So it's been a fun month. But
keys in these things or something?
my wife did. I don't know how they got mine, but no. So I was at the Ford dealership in Orlando by my house, and they only had like 10 F-150s.
Yeah.
And I was like, well, I was like 50-50 to like buy it or just do another lease. And I was like, well, what if I wanted like a bigger car? Cause I have 3 daughters. So I was like, I need like a bigger car. And they're like 20 weeks for like an expedition. I was like, are you kidding me?
And I have a 150 on order, and they tell me it'll be April before I get it.
Yeah. I should have just got it.
Premium did you pay for?
Oh, I'm gonna end up paying full sticker on it. You wait. Right now, I don't even know what it is. This is one of those electric ones.
Yeah.
And they just, you put your name on the list. They tell me they're shutting down the list because they've got too many names. Good place to be for Ford.
Yeah. So
I don't think I'll ever see the truck. I think what's gonna happen is that my truck will come up and somebody will snatch it away from me for
The government, the whole debate about this being transitory is going on because nobody wants to confront what happens to $29 trillion worth of debt if interest rates do go up appreciably. I mean, it's just consequences.
Yeah, I know.
Comprehensive.
Glad we did most of that with when the rates were at zero, right?
Well, maybe
This
not.
was this, I don't know, you looked at the Wall Street Journal this morning.
I've got it.
That's one of the editorials that says Tweedledum and Tweedledee is trying to figure out who they're gonna put in as head of the Fed.
Yeah.
And
now you got-
that's pretty ugly words when you get right down to it. I mean, it is.
It really is. And now you got this, you've almost politicized the Fed. Can he actually taper now? If that has the consequence of significantly raising treasury rates?
You have to remember also politically what's coming next year. And another midterm election. What will the Fed do? Because
He's
will
not-
affect that election, one way or the other.
I don't think he's going to think. He's going to try and keep rates, like they've been doing, keep rates down.
That's why I think lower for longer.
Yeah.
I mean, until, once again, international rates decide to.
But
jump
then
on
what's
that.
the consequence of that to the currency? If you so artificially control it, continue to.
What do they say, the best pig with the most lipstick or whatever, it is,
Yeah.
whatever that saying is.
Lipstick on a pig.
On a pig, yeah.
It's my daughter's problem, not ours.
That,
So, all right, well, thank you for your time.
thank you, John.
Okay.
What?
Adjourn.
Oh, yeah, well,
It's on the editorial.
yeah, that's this morning's.
Oh, new business. Yeah, so
Business first.
with John's absence, he and I were discussing whether we had a vice chairman. I recall that I thought we elected a vice chairman, but I think it may have been Chris, and he's no longer with us. So,
It's been during my tenure.
right. It was at least 3 or 4 years ago. So, we thought the committee could discuss if they wanted to elect a vice chairperson. I thought John might want to be here for the discussion, but he said, go ahead and have it. So if the committee does want to nominate someone and vote on them, we could do that now. We could do it, at a later meeting, whatever the committee wants to do. It's really up to you guys.
I'm comfortable with him as vice chairman, but I'd rather do it when John's around. If you don't mind, no, I'm not cutting you or anything, but
No, I was
I
going
just
to,
put it off.
I was going to rest for here, no matter how bad.
We can reschedule the discussion for the December meeting. Sure.
Similarly with John, is the phone-in policy or the absentee policy the same?
So my understanding, based on the most recent information, and we discussed this at the last meeting, is that any committee member is welcome to join virtually. But if you want to vote, you need to have that affidavit signed and notarized. So John could have called in today or joined through Zoom, and he could have participated and discussed, issues. But if there were a vote taken, he could not have voted because he didn't have that form submitted.
The question is, does he count as a
Is it
quorum?
that specific?
Yeah,
No, he can't. If you
signed the form,
if you sign the form, you can be part of the quorum, but you can't vote. It has to be notarized to be voted, to be able to vote.
welcome to government.
Yeah,
Dates.
I didn't make those rules up.
No, nobody accused you.
Well, I just want a clarification, because
Yeah.
like John's gone today, he
Right,
was gonna call in, but we started a little late, I don't know what happened. there.
right.
All right. Looks like we're done. Any, look for a motion to adjourn, unless there's anything else.
So moved.
Favor? Thank you.